Somebody's joined us before as well. Tarun Birani of TBNG Capital Advisors joins us right now on the show. Tarun, thanks so much for taking the time out and joining us again. A lot of investors have written to us saying that people at the higher age bracket are being promised that 1% return per month if you invest in mutual fund scheme. How is that even possible?
Neeraj, the whole background I see it is investing is all about behavior. And I have seen that almost last 2-3 years, whatever the markets have been doing well. So a behavior bias called a recency bias, which I normally quote many times, because what has happened in last 2-3 years, it is, and when you meet your friends, a lot of family members and all that, you come across that they are generating a lot of good returns. And due to that, there is a lot of fancy to make quick buck. And in that, there is no proper attention is given towards suitability, whether it is suitable for them or not.
Sure.
They just get into it, dive into it, and I think we have seen lots and lots of accidents happening just because of that case.
But this is suitable, right, Tarun? I'm 60, I'm 65, I've retired. Somebody comes and tells me that I can invest in a scheme which will give me 1% guaranteed. Why would it not be suitable for me? The question mark is only that, is this even possible in the first place?
Yeah, so it is all about a lot of mis-selling around this entire piece. I have also came across a lot of messages which promises a fixed dividends on a monthly basis. So it's, I think mutual funds, there is always, SEBI has taken a lot of move in terms of communicating it right, that you can't get guaranteed returns in mutual funds, right?
So you are saying that not only is that 1% dividend certainty not possible, but even a dividend of 1% may not be possible. So there are two mixed mistakes out here. One is that a 1% annualized over 12 months may not necessarily happen.
Correct.
And even if there is a dividend happening, you may not have a 1% dividend. The dividend may well be 0.5% or even lower than that.
Correct. I think we need to go a little deeper into this, how these dividends are given. These dividends are given based on the investable surplus which are available to these schemes, specific schemes. So in good times, we have seen these schemes have good investable surplus available, and based on that, they can give dividends. But if, let's say, we have a continuous bout of, let's say, 6 months or 9 months of a bear market run, I think it's quite possible that these dividends will not be delivered. So end of the day, we need to understand which kind of products we are investing. And if we are investing a pure equity fund, everyday market fluctuations are going to affect the NAVs of those funds. So I think dividends there does not make any sense. Coming to balanced fund, which are little more debt, mix of equity debt, but there also a majority of the portion is dependent on the market performance. So there also dividends, certainties, a question mark, big question mark. And the third category is a debt category. So debt category, I would say it is not at all tax efficient to take dividends, because less than 3 years, if you are in a taking a dividend from debt fund, it is very high. 30% you are paying as a tax rate. It doesn't make sense. So to my mind, investors should not come with any dividend mindset, regular income mindset. I think there are structures like SWP, systematic withdrawal plan, which should be used there. Those are much more efficient ways to, if you are looking at a cash outflow for retired people, I would recommend SWP as a better option.
There are a few questions, Tarun, that have come in, and I would want you to answer some of those. Sure. But if I want a fixed set of returns, without getting into the or the quantum of the return coming in, what's the best option available?
And I think debt funds are the only products available if you're fixated with a fixed deposit kind of mindset. So fixed return.
Or would debt funds offer a return which is better than what a fixed deposit would offer?
So post-tax returns, yes, are much more efficient than a fixed deposit because of the taxation advantage which they get. I think if somebody is ready to take some bit of risk, you can even get much more and have a time horizon of 2 year plus, 2 to 3 year plus. I think one can look at dynamic asset allocation funds. Those are beautiful.
What do they do?
So these funds have the ability to increase or decrease the equity level of the funds based on the market movements. And here post 1 year, you have equity taxation also coming in.
On an average, what would be a return that a dynamic asset allocation fund can deliver?
So dynamic asset allocation returns historically have varied between, with a 3 year plus horizon, have been between 10 to 12% tax-free returns, which they have delivered. And the good part is I have seen them in the 2011-12 crash. I've seen them in 2016 when the markets were 3% negative. At those times, these funds have been able to deliver 6-7% positive returns. And they're much more tax efficient. Post 1 year, that's a completely tax-free product available.
Okay.
So I think why get into a debt fund? If you're ready to take some risk and a good time horizon, I think this is the place one should look at.
Senior citizens are being offered these schemes with a guaranteed return.
Yeah.
And since we have established that that is not the right way to approach something like a certain return is not possible, I want to ask you, for somebody who is northwards of 60 and looking to invest into mutual funds, what are the best products available right now? If you have a couple of names, then even better.
The gentleman has a time horizon of 3 year and 5 year plus.
Yeah, let's work with an assumption that the horizon is 5 years plus.
So if you're looking at 5 year plus and in looking at the current market scenario, I would recommend looking at dynamic asset allocation products because they can get you good tax efficient returns. And in the current environment of low interest rates, I think you need to look at products outside those fixed deposit mindset.
Okay. And for somebody who is wanting the regularity of returns, is there a product available currently?
So for regularity of return, I feel that the systematic withdrawal plan option.
But that would be for somebody who's got a lump sum amount in place. What if somebody doesn't have a lump sum amount in place?
No, so he can accrue that amount over a period of time and then they can create a SWP portion for them, which can give them a regular income on a cash outflow can be available.
Okay. Any last question, Tarun? Any examples of a dynamic allocation fund which is good to invest into currently, and a systematic withdrawal plan of any fund house which you believe is good?
So I think systematic withdrawal is a concept, you can use it anywhere, but I would say dynamic asset allocation fund, I think one of the biggest dynamic asset allocation fund is a ICICI Balance Advantage Fund, which is almost a 20,000 crore plus scheme. But I have seen over a period of time, this scheme has delivered good risk adjusted return. The standard deviation of this fund is almost 7-8% compared to a normal balance fund 12-13%. Okay. And an equity fund of 20%. So your risk is reduced dramatically, but returns are nice and tax-free. So it's a beautiful option available according to me.
Tarun, thanks so much for joining in today and giving us your thoughts. And viewers, thanks for tuning in to the Mutual Fund Show.